There is a Social Security change coming in 2026 that almost nobody is talking about right now. It does not involve your COLA raise, and it is not about Medicare premiums going up. This particular change affects the way your benefits are calculated if you are still working. If you miss it, you could lose hundreds of dollars every single year without even realizing what happened. I have spent over 30 years helping seniors just like you protect every dollar they have earned. In all that time, I have never seen a change slip under the radar quite like this one. The Social Security Administration quietly updated rules that will reshape how earnings interact with your benefits. By the end of this video, you will know exactly what changed and exactly what to do about it. Most people will scroll right past this information because the headlines are all focused on the cost of living adjustment. But this change is arguably more important for anyone between 60 and 70 who still earns income. It could mean the difference between keeping your full check or watching part of it vanish. So please stay with me for the next 20 minutes, because this one truly matters. Let me give you some context so this all makes sense from the ground up. In 2025, approximately 68 million Americans received Social Security benefits each month, according to SSA.gov. That is nearly 1 in every 5 people in this entire country collecting a check. The total annual payout exceeded $1.4 trillion, making it the largest benefit program ever created. Now here is the part that sets the stage for what is changing in 2026. Social Security has always had something called the Retirement Earnings Test, or RET for short. This test determines whether some of your benefits get temporarily withheld if you earn above a certain threshold. Think of it like a toll booth on your income highway, where the government takes a portion before you pass through. In 2025, the earnings limit for people under their full retirement age was $23,400 per year. That means if you earned even $1 above that amount, Social Security withheld $1 for every $2 over. For someone in the year they reach full retirement age, the limit was $62,160. Above that higher number, $1 was withheld for every $3 over the limit. The reason this matters so much is that millions of seniors continue working part-time or even full-time after they start collecting. According to SSA.gov data, roughly 11 million beneficiaries under age 70 reported earned income. Many of them do not realize they are subject to the earnings test until they see a smaller check. By then, the damage to their monthly cash flow has already been done. Let me put this in real-world terms so you can feel the impact right now. Imagine your neighbor Betty collects $1,400 a month in Social Security and earns $30,000 a year. In 2025, she exceeded the earnings limit by $6,600 after subtracting the threshold. That means Social Security withheld $3,300 from her benefits that year, roughly 2.5 months of checks. Now let us get into exactly what is changing for 2026 and why it caught my attention immediately. The Social Security Administration has announced that the earnings test exempt amount for 2026 will be adjusted upward. According to preliminary figures from SSA.gov, the under full retirement age limit is expected to rise to approximately $24,120. That is an increase of roughly $720 over the 2025 threshold. On the surface, a $720 increase sounds like good news, and in some ways it is. It means you can earn an extra $720 before the earnings test kicks in. But here is the problem that most people will completely miss in 2026. The increase is smaller than many seniors expected because it is tied to average wage growth, not inflation. In years when inflation runs hot, but wage growth lags slightly behind, the gap works against you. Your cost of living goes up faster than the amount you are allowed to earn without penalty. So even though the exempt amount increased, your real purchasing power may not keep pace. This mismatch is the silent change that erodes your financial position 1 month at a time. Let me show you the actual dollar impact, with a specific example using projected 2026 numbers. Say you are 63 years old, collecting $1,500 a month in Social Security. You also work part-time, earning $32,000 a year before taxes. Under the 2026 threshold of approximately $24,120, you exceed the limit by $7,880. Social Security would then withhold $3,940 from your benefits over the course of 2026. That works out to about $328.33 per month taken from your check. In practical terms, your $1,500 monthly benefit drops to roughly $1,172. That is a significant hit that many people never anticipate until the checks start arriving short. Now compare that to what would have happened if the threshold had kept pace with actual inflation. If the limit had been adjusted to around $25,000 instead, you would only exceed it by $7,000. The withholding would drop to $3,500 for the year, instead of $3,940. That $440 difference is money that stays in your pocket if the threshold were higher. Here is another layer of this that really caught my eye when I dug into the numbers. The earnings test threshold for the year you reach full retirement age is also being adjusted for 2026. According to SSA Gov projections, that higher limit will rise to approximately $63,960. While that sounds generous, it still catches many seniors who work in professional or consulting roles off guard. If you turn 67 in August of 2026 and your full retirement age is 67, a special rule applies. Only earnings from January through July count toward the earnings test in that scenario. But many people do not realize this and either over-report or under-report their earnings to Social Security. Getting this wrong can trigger unexpected benefit withholding or even an overpayment notice months later. Let me walk you through what happens if you accidentally trip the higher threshold in your FRA year. Say you earn $80,000 between January and July of 2026 before reaching full retirement age. You exceed the $63,960 limit by $16,040 in that period. Social Security withholds $1 for every $3 over, which comes to $5,347. That withholding is not permanent, and I want to make sure you understand this crucial detail. Once you reach your full retirement age, Social Security recalculates your benefit to credit back those withheld months. Your monthly payment gets bumped up to account for the months you did not receive a full check. But the recalculation takes time, sometimes 6 to 12 months, and the adjustment is spread over your remaining lifetime. This means you will not get a lump sum refund of everything that was withheld over the years. Instead, your monthly check increases by a small amount, maybe $20 to $40 a month permanently. Over 10 or 15 years, you eventually recover the withheld money through those slightly higher payments. But if your health is uncertain, you might never fully recoup what was taken from your checks. Stay with me, because what I am about to show you will surprise you about how this interacts with taxes. Most seniors do not realize that the earnings test and income taxes on Social Security are two completely separate systems. You can be hit by both at the same time, creating a double penalty on your hard-earned money. Understanding how these two systems overlap is critical to keeping more of your benefits in 2026. Here is how the tax side works in plain English without any confusing accounting language. The IRS uses something called combined income to determine if your Social Security benefits are taxable. Combined income equals your adjusted gross income plus non-taxable interest plus half of your Social Security benefits. If that number exceeds $25,000 for a single filer, up to 50% of your benefits become taxable. For married couples filing jointly, the threshold jumps to $32,000 for the 50% level. If your combined income exceeds $34,000 as a single filer, up to 85% of your benefits get taxed. For joint filers, that 85% threshold is $44,000 combined income. These thresholds have not been adjusted for inflation since 1993, which is 33 years by 2026. Let me show you what this looks like with a realistic 2026 scenario that will open your eyes. Suppose you and your spouse together receive $28,000 annually in Social Security benefits. You also have a part-time job earning $26,000 a year and a small pension of $8,000. Your combined income would be $26,000 plus $8,000 plus $14,000, which equals $48,000. Since $48,000 exceeds the $44,000 threshold for joint filers, 85% of your benefits are taxable. That means $23,800 of your Social Security is subject to federal income tax. At even a 12% tax bracket, you owe roughly $2,856 in extra federal taxes. This is money coming directly out of benefits you spent decades earning through payroll contributions. Now layer the earnings test on top of this tax situation and the picture gets really painful. If your spouse is under full retirement age and earning that $26,000, they exceed the earnings test limit. Social Security withholds roughly $940 from their benefits for the year in 2026. Combined with the income tax hit, you could lose nearly $3,800 total from your household benefits. The cruel part is that neither the earnings test thresholds nor the tax thresholds are keeping up with reality. Wages go up, prices go up, but these critical numbers barely budge from year to year. Every year that passes without a meaningful adjustment pushes more middle-income seniors into penalty territory. This is the change most seniors will miss because it happens gradually, like a slow leak in a tire. I want to give you a clear comparison so you can see the trend over the past several years. In 2020, the earnings test exempt amount was $18,240 for those under full retirement age. By 2023, it had risen to $21,240, an increase of $3,000 over 3 years. From 2023 to 2026, the increase is projected to be only about $2,880 over those 3 years. The rate of increase is actually slowing down, even though the cost of everything around you is accelerating. Groceries, insurance, property taxes, and medical costs have all outpaced these threshold adjustments. This means more seniors will bump up against the earnings test, even with modest part-time income. The system is quietly tightening around your benefits without any legislation or headline-grabbing announcement. Think about it this way using a simple kitchen table comparison that makes this crystal clear. In 2020, you could earn about $1,520 a month before the earnings test applied. By 2026, that monthly exempt amount is projected to be about $2,010 a month. But monthly expenses for a typical senior household have risen by roughly $560 over that same period. So your breathing room has actually shrunk by about $220 a month in real purchasing power. That $220 a month translates to $2,640 a year in lost flexibility. If you are trying to supplement your Social Security with part-time work, this squeeze matters enormously. It can mean the difference between paying your bills comfortably and falling behind on 1 or 2 payments each month. Now here is the part most seniors never hear about when it comes to the 2026 earnings test changes. There is a special provision in Social Security law that allows certain types of income to be excluded entirely. Not all money you receive counts as earnings under the retirement earnings test according to SSA. Gov guidelines. Understanding what counts and what does not could save you thousands of dollars in withheld benefits every single year. The retirement earnings test only counts wages from employment and net self-employment income against the threshold. It does not count investment income, pension payments, annuity distributions, or interest and dividends. It also does not count government benefits, inheritances, rental income from property, or capital gains from investments. This means you could receive $50,000 in rental income, and it would not trigger any earnings test withholding. Let me give you a specific example to show how powerful this distinction really is for your planning. Margaret is 64 years old and collects $1,600 a month in Social Security benefits. She earns $15,000 a year from a part-time retail job and receives $12,000 in rental income. And only the $15,000 in wages counts against the earnings test, keeping her well under the 2026 threshold. If Margaret had earned that entire $27,000 from wages instead, she would exceed the limit. Social Security would withhold approximately $1,440 from her benefits that year. But because $12,000 of her income comes from rent, she keeps every penny of her Social Security check. This is not a loophole or a trick. It is simply how the law was written, according to SSA.gov. Now here is where it gets even more interesting for anyone with a small business or side hustle. If you are self-employed and over your full retirement age, the earnings test no longer applies to you at all. But if you are under full retirement age and self-employed, only your net earnings from self-employment count. That means after you subtract legitimate business expenses, your countable income could be significantly lower than your gross revenue. For example, suppose you do freelance consulting and bill clients $40,000 in 2026 as gross revenue. After deducting your home office, travel, supplies, software, and other legitimate expenses, your net is $22,000. That $22,000 is under the projected 2026 threshold of $24,120. You would not have a single dollar withheld from your Social Security benefits despite billing $40,000 in gross income. Compare that to someone earning $40,000 as a regular employee with no deductions against the earnings test. That employee would exceed the threshold by $15,880 in 2026 earnings. Social Security would withhold $7,940 from their benefits over the course of the year. The difference between these two scenarios is nearly $8,000, simply based on how the income is structured. I also want you to understand how the substantial services test works for self-employed seniors in 2026. If you work fewer than 45 hours per month in your business, Social Security may not count those months. Each month where you work fewer than 15 hours is almost always considered not substantial service. This monthly test can protect individual months of benefits even if your annual income exceeds the threshold. The monthly test is an alternative to the annual test, and Social Security uses whichever one benefits you more. In the first year you claim benefits, the monthly test is typically more favorable according to SSA.gov guidelines. This is especially valuable if you retire mid-year and have already earned a lot in the earlier months. You could collect full benefits for every remaining month where you stay under the monthly earnings limit. For 2026, the monthly exempt amount under the earnings test is projected to be approximately $2,010. If you earn less than $2,010 in any given month, you receive your full benefit for that month. This applies regardless of how much you earned in other months of the same year. So even if you earned $50,000 from January through June, months where you earn under the limit are protected. Let me paint a very specific picture so you can see how to use this monthly test in your favor. Suppose you retire from your full-time job on June 30th of 2026 after earning $60,000 year-to-date. From July through December, you do light consulting work earning $1,800 per month. Because $1,800 is under the $2,010 monthly limit, you receive full benefits for those 6 months. Without the monthly test, your annual earnings of $70,800 would massively exceed the threshold. Social Security would potentially withhold over $23,000 from your benefits for the entire year. But because the monthly test protects July through December, you keep 6 full months of benefit checks. This single provision could save you over $9,000 in the year you actually retire. Now I want to reveal the hidden gem that most seniors and even many financial advisors completely overlook. There is a form called SSA 561U2, which is the Request for Reconsideration form available at ssa.gov. If Social Security withholds benefits based on an earnings estimate that turns out to be too high, you can request adjustment. Many seniors never file this form and end up losing money they were legally entitled to keep. Here is how this works in practice and why it matters so much for your 2026 planning. At the beginning of the year, Social Security estimates your earnings and withholds benefits based on that projection. If you end up earning less than they estimated, they withheld too much from your monthly checks. You have the right to contact Social Security and request that the overpaid withholding be returned to you. The eligibility criteria for this adjustment are straightforward and apply to almost everyone affected by the earnings test. You must have had benefits withheld due to the retirement earnings test during the tax year in question. Your actual earnings must have been lower than the estimate Social Security used for withholding calculations. And you need to provide proof of your actual earnings, typically through your W-2 or tax return documentation. According to ssa.gov, you can request this reconsideration by calling 1-800-772-1213 or visiting your local office. You can also submit the request online through your My Social Security account at ssa.gov if you prefer. The deadline to request a reconsideration is generally within 60 days of receiving the withholding notice. However, Social Security does allow late requests if you can show good cause for the delay. I have seen clients recover anywhere from $400 to over $3,000 through this single process. Many of them had no idea this option even existed until I walked them through it at my office. The money was simply sitting there, unclaimed, because nobody told them they could ask for it back. Do not let that happen to you in 2026 when every dollar of your Social Security check matters. Now let me give you your specific action steps so you can protect your benefits starting right now today. First, log into your My Social Security account at ssa.gov and review your current earnings estimate for 2026. If you expect your earnings to change, update your estimate immediately so withholding is calculated correctly. An accurate estimate prevents over-withholding and keeps more money in your bank account each month. Second, review the type of income you receive and determine what counts under the retirement earnings test. Remember that only wages and net self-employment income count against the earnings threshold limit. If you can shift some earned income into investment income or rental income, your benefits stay more protected. Speak with a qualified tax professional before making any changes to how your income is structured. Third, mark your calendar right now with key dates and contact numbers you may need during 2026. The Social Security Administration can be reached at 1-800-772-1213, Monday through Friday, 8 a.m. to 7 p.m. Your local Social Security office can be found by entering your zip code at ssa.gov office locator page. If you receive any withholding notices, respond within 60 days to preserve your reconsideration rights under the law. Here is the single most important thing I want you to take away from everything we covered today. The 2026 earnings test threshold increase is smaller than it appears when you account for rising costs of living. But armed with the right knowledge about what income counts, the monthly test, and the reconsideration process, you can fight back. You do not have to accept every dollar of withholding as final, because the system has protections built in for you. If this video helped you understand something you did not know before, I would appreciate you hitting subscribe below. I put out new videos every week focused specifically on helping you protect your Social Security and Medicare benefits. Next week, I am covering a little-known Medicare rule for 2026 that could save you over $600 a year. Until then, take care of yourself, and remember that knowledge is the best protection your retirement savings will ever have. This channel is for educational purposes only, and does not constitute financial or legal advice. Always verify directly with SSA.gov or Medicare.gov.